Hello everyone, and welcome to this technical analysis video here at xm.com. We have a relatively busy week ahead of us with the US and UK inflation numbers for October taking center stage as investors try to figure out the next monetary policy steps of the Fed and the Bank of England. The Aussie will also be a protagonist this week, with those trading it eagerly awaiting Australia's jobs report and a bunch of data coming out of China. Now, with all that in mind, we will take a look at the euro-dollar, pound-dollar and Aussie-dollar pairs. Getting the ball rolling with the US CPIs and the US dollar, of course. The data comes out on Tuesday, and expectations are for the headline rate to have declined to 3.3% year over year from 3.7%. The core one is expected to have ticked down to 4% from 4.1%. This could add credence to investors' belief of no more rate hikes by the Fed and also several cuts for next year, and perhaps hurt the dollar. Now, euro-dollar weakened somewhat last week, but it remained above the key support zone of 106.65. Remember that the pair returned above that zone when we had the latest disappointing NFP report, and despite the setback, it remained above that territory. Now, slowing US inflation could result in another leg north in this pair, and we could see a test near the 107.65 zone, or near this prior upside support line that could now play the role of a resistance. However, the outlook would still not be positive, even if we see the break above the upside support line. Because the pair would still be within the range between the 106.65 barrier that we already mentioned and also the 110.70 zone. That's a range that's been containing most of the price action. It contained most of the price action between January and September, and now the pair is back within that range. For the outlook to turn overly positive, I believe we need to see a break above the 110.70 zone. Now, on the downside, if we have hotter than expected US inflation, euro-dollar could return back below the 106.65 barrier, a move that could turn the outlook cautiously bearish again, and perhaps set the stage for declines towards the low of October 3rd at around 104.45. Now, let's pass the ball to the UK CPIs and the pound. The forecasts for the UK data points to a slowdown as well, but with the UK PMIs suggesting that prices charged by companies accelerated to a 3-month high in October, the risks here may be tilted to the upside. This could help pound dollar move higher, especially if the US CPIs the previous day come in softer than expected, and so cable could move higher, could move above the 123.10 key barrier. Prior support recently acted as a resistance. Now the market may be seeing it as a resistance again. So we could see the pair breaking above that zone and perhaps emerging above its 100 and 200 day exponential moving averages. A break higher could see scope for extensions towards the 126 territory, marked by those inside swing lows. However, similarly to euro-dollar, the outlook would still be neutral, as the pair would still be within the sideways range between 123.10 and 128. For the outlook to turn positive, the pair may need to break above 128. Now, on the downside, cooler than expected UK figures could trigger another round of selling, perhaps taking this exchange rate near the downside line drawn from the high of July 13th or near the round figure of 120. Now, last but not least, we have the Aussie and Australia's jobs data. The Aussie has been under pressure last week following the RBA's dovish hike, as well as data and developments adding to concerns about China's economic performance. Now, traders may pay close attention to Thursday's employment report for October and also some Chinese data the day before. Now, jobs report, an Australian jobs report pointing to a still tight labour market could help Aussie dollar rebound, perhaps taking it back near or above the 0.64 territory. However, any recovery could be limited and short-lived if China's data the previous day, that is on Wednesday, add to the gloomy picture of the world's second largest economy and Australia's main trading partner. As long as the pair remains below the 0.65 important territory, which acted as a resistance several times recently and also played the role of a support in the past, the technical outlook would remain bearish, and another round of selling, even if we see a small recovery, could result in another test slowly towards the 0.6280 zone that provided support between October 4th and October 26th. Now, for the outlook to start looking bright in this pair, and also to suggest that the bulls have stolen all the bears' swords, the pair may need to emerge all the way above the crossroads of the key area of 0.6570 and the 200-day exponential moving average. So that's it from me. Thank you very much for watching and listening. I hope you have a nice rest of the day and a great rest of the week.